If you have ever deposited cash into your bank account and deliberately kept it under a certain amount just to avoid dealing with extra paperwork, you might have just committed a federal crime without even realizing it. The money could be completely legal. You could have paid every dime of taxes on it, but simply altering how you deposit it triggers a silent alarm that could result in your entire account being frozen. You are watching this because you want to protect what is yours. You work hard for your money, you pay your taxes, and you trust the financial system to keep your assets secure. But right now, there is an invisible web of surveillance operating behind the counters of every bank in America. Over the next few minutes, we are going to pull back the curtain on the banking system's deepest secrets. We are going to explore the automated tripwires that the IRS and the Financial Crimes Enforcement Network use to monitor your everyday transactions. We will uncover why trying to protect your privacy might actually flag you as a criminal, how the updated 2026 tax reporting rules are changing the game entirely, and finally, the exact number you must never try to outsmart. If you understand these rules, you will be completely safe. If you do not, you could lose everything you have worked so hard to build. Let us get right into it. I want you to imagine a perfectly normal scenario. You just sold a used truck to a neighbor. They paid you $14,000 in cash. You take that cash and you walk into your local bank branch. You walk up to the teller window, you slide the money across the counter, and you ask to deposit it into your checking account. The teller smiles, types a few things into their keyboard, hands you a receipt, and wishes you a great day. You walk out to your car feeling perfectly fine. But what you do not know is that the moment you walked away, an automated process began in the background, entirely outside of your view. You see, most people still view their bank as a neutral vault, a quiet, secure place that simply holds onto your money and facilitates your spending. But the modern banking system is no longer just a storage facility. Under federal law, your bank operates as a deputized surveillance arm of the United States government. They are legally mandated to monitor, analyze, and report on your financial behavior, and they are legally forbidden from telling you when they do it. To understand how we got here, you have to understand the Bank Secrecy Act. Originally passed decades ago and heavily expanded over the last 20 years, this law fundamentally shifted the responsibility of catching financial criminals away from traditional law enforcement and placed it squarely onto the shoulders of banks, credit unions, and even digital payment platforms. The government essentially told the financial institutions that if they fail to catch illegal money moving through their systems, the institutions themselves will face billions of dollars in fines. Faced with that kind of pressure, the banks did what any corporate entity would do. They overcorrected. They built massive, highly sensitive, automated algorithms designed to flag anything that looks even slightly out of the ordinary. And this brings us to the first major tripwire that average, everyday citizens accidentally cross all the time: the Suspicious Activity Report, commonly known as a SAR. A Suspicious Activity Report is exactly what it sounds like. It is a document that a bank files with the Financial Crimes Enforcement Network, or FinCEN, whenever a customer conducts a transaction that the bank's software or employees deem unusual. Now, what defines unusual? That is the terrifying part. It is completely subjective, and it is largely driven by artificial intelligence. If you are someone who typically receives a direct deposit every 2 weeks and occasionally takes out $200 from an ATM, your profile is established. The algorithm knows who you are, but suddenly you withdraw $8,000 in cash to pay for home renovations, or you deposit $5,000 from selling some old furniture. To you, this is just life. To the algorithm, it is an anomaly. The system immediately flags the transaction. The teller looking at the screen might see a prompt asking them to inquire about the source of the funds. Have you ever wondered why the teller casually asks you what you plan to do with the cash or where it came from? They are not making small talk. They are filling out a data field on a compliance screen. If your answer seems vague, or if you seem defensive, or if the transaction just simply breaks your historical pattern too sharply, the bank will quietly file a suspicious activity report. And here is the most crucial detail you need to remember. Under federal law, it is a criminal offense for a bank employee to disclose to a customer that a SAR is being filed. It is called a gag order. They will smile, they will give you your receipt, they will offer you a lollipop for your child, all while submitting a federal report detailing your behavior as potentially linked to money laundering, tax evasion, or terrorist financing. You will never get a letter in the mail. You will never get an email alert. The report simply vanishes into a massive government database in Virginia, where it sits waiting for algorithms to connect it to other pieces of your financial life. This system traps innocent people because the algorithms do not possess human context. They do not know that you are a grandmother withdrawing cash to give to your grandchildren for the holidays. They do not know that you are a small business owner who just had a really good weekend at a local flea market. They only see data points that align with risk models. And over the last few years, these risk models have become incredibly aggressive. The government has heavily emphasized the monitoring of what they call microstructuring, which is the act of making repetitive, sub-threshold cash withdrawals or deposits that correlate with payroll cycles but happen outside of regulated payroll systems. If you pay independent contractors in cash, or if you regularly draw cash to pay for off-the-book services, the system is designed to catch that exact cadence. The bank might tolerate it for a few weeks or months, but eventually the algorithm decides that the risk of keeping you as a customer outweighs the profit of holding your money. This is when people suddenly find their debit cards declined at the grocery store. They log into their mobile banking app and see a message saying their account is locked. They call customer service, and the representative reads a scripted line stating that the institution has decided to sever the relationship and a cashier's check will be mailed in 30 to 60 days. Your money is frozen, your bills bounce, your credit score takes a hit, and you have absolutely no recourse, all because a computer program decided your perfectly legal behavior looked suspicious. But the physical cash at the teller window is only one half of the battlefield. The second major tripwire you need to understand revolves around your digital footprint and the evolving reporting landscape that is actively taking effect right now. For a long time, people believed that if they avoided physical paper money, they could avoid government scrutiny. They assumed that if they kept their transactions digital, but broke them up across different apps and platforms, they could fly under the radar. But as we step into the reality of 2026, the reporting rules have fundamentally changed, creating a net that is much tighter and much more sophisticated than ever before. You have likely heard the endless back and forth over the last few years regarding IRS reporting thresholds, specifically concerning Form 1099-K and Form 1099-NEC. For a while, the panic was all about the $600 threshold. If you sold a couch on the internet or did a little freelance work and received more than $600 through a third-party payment network, you were suddenly going to get a tax form. The IRS delayed and modified these rules repeatedly because the sheer volume of paperwork threatened to collapse their own systems. But now, under the updated 2026 frameworks, we have stepped into a new standardized era. The reporting threshold for many of these information returns, including payments for services to non-employees and backup withholding triggers, has been elevated and anchored at $2,000 per calendar year, with adjustments for inflation built in for the future. Now on the surface, moving from a $600 threshold up to a $2,000 threshold sounds like a victory for the little guy. It sounds like the government is backing off and giving everyday side hustlers room to breathe. But human nature makes people try to outsmart the system, and that is where the tragedy begins. Because people know about this $2,000 limit, they start playing games with their digital money. Let us say you are a graphic designer doing freelance work, or maybe you rent out a spare room in your house. A client owes you $4,000. Instead of just sending you a single payment, you tell them to send $1,900 to your Venmo account. Then you ask them to send another $1,900 to your Zelle account. And for the final $200, you ask for cash. You do this because you think you are being clever. You think you are keeping every individual stream of income under the $2,000 reporting threshold, thereby avoiding the IRS paperwork. This is a monumental mistake, and it highlights the massive difference between tax evasion and reporting evasion. You might fully intend to claim every single dollar on your tax return at the end of the year. You are not trying to cheat the government out of their tax revenue. You are just trying to avoid the annoyance of the 1099 forms or the scrutiny of a business audit. But the digital systems running PayPal, Venmo, CashApp, and your centralized bank do not see it that way. These platforms are fully integrated with identity verification systems that tie back to your social security number. When you intentionally fragment digital payments across multiple platforms to stay under a known reporting limit, the aggregation software flags your profile. You are signaling to the algorithms that you possess specific knowledge of compliance thresholds and that you are actively taking steps to circumvent them. Think about how that looks to an artificial intelligence program trained to spot money launderers. A money launderer tries to break large sums of illicit cash into smaller, untraceable pieces. When you break up a legitimate payment into 3 different pieces across 3 different apps just to avoid a 1099 form, your digital behavior perfectly mimics the digital behavior of a cartel operative. The algorithms do not care that you are just a graphic designer avoiding paperwork. They issue the flag, they file the digital suspicious activity reports, and suddenly your payment app accounts are permanently banned for violations of the terms of service. Even worse, the IRS cross-references these fragmented payments. The systems are designed to detect aggregation. When they see a pattern of transactions hovering just beneath the mandatory reporting limits, it dramatically increases your audit risk score. By trying to fly under the radar, you inadvertently paint a massive target on your own back. The absolute safest thing you can do in the digital economy of 2026 is to consolidate your payments, accept the forms, and operate entirely in the light. The moment you start fracturing your money to hide from an automated threshold, the system will catch you. We have covered the invisible algorithms tracking your digital footprint and the new thresholds taking effect right now. But everything I have just shared with you about digital footprints and suspicious activity reports pales in comparison to the ultimate trap. There is a specific number, a specific threshold that has ruined more innocent people's lives than any other banking rule in existence. And if you attempt to tiptoe around this number, you can lose every penny in your account. We are going to break down exactly what that number is and how to navigate it, because it is the most critical lesson in personal finance you will ever learn. The number is $10,000, and the Tripwire is called the Currency Transaction Report, or the CTR. Under federal law, anytime a person physically deposits or withdraws more than $10,000 in cash in a single business day at a financial institution, the bank is required by law to file a currency transaction report. Unlike the suspicious activity report, which is a secret, the CTR is not a secret at all. If you walk in with $12,000 in cash, the teller will look at you, pull out a form, and ask you for your driver's license. They will ask you for your occupation. They will ask for your social security number. They will type all of this into the system, and they will openly tell you that they are filing a report with the government because the transaction is over $10,000. Most people inherently distrust the government tracking their money. So when they hear about this $10,000 rule, their instinct is to protect their privacy. They think to themselves, why would I willingly trigger a government report? Why would I invite the IRS into my business? I will just make it easy. Instead of depositing the $12,000 all at once, I will go to the bank on Tuesday and deposit $6,000. Then I will go back on Thursday and deposit the remaining $6,000. Or maybe they have exactly $10,000 and they decide to deposit $9,500 and keep $500 in their wallet, specifically so the teller does not have to fill out the form. This is the fatal mistake. When you deliberately alter your deposit or withdrawal behavior for the purpose of evading the currency transaction report, you have committed a federal felony known as structuring. Let me repeat that because it is the most misunderstood law in the financial system. Structuring your cash deposits to evade a bank reporting requirement is a federal crime under Title 31 of the United States Code. And here is the truly terrifying part. The money involved does not have to be illegal. You could have earned that $12,000 by building a deck for a neighbor, working 80 hours in the hot sun. You could have paid every single cent of income tax on that money. The money could be as pure as the driven snow. But the moment you split it in half to avoid the bank form, the act of splitting it becomes the crime. The government created this law originally to target drug cartels and organized crime syndicates who were moving massive amounts of illicit cash. They knew criminals would try to keep deposits under $10,000 to avoid detection, so they made the act of dodging the threshold a crime in itself. But today, this law routinely snares innocent restaurant owners, barbers, contractors, church donation organizers, and retirees. It catches people who simply do not want to be bothered with the paperwork or who mistakenly believe that filing a CTR will trigger a tax audit. When you deposit cash in a pattern that looks like structuring, the bank's internal systems will catch it immediately. They are programmed to look for cash deposits ending in round numbers just below the threshold, or whack-room deposits of $8,000, $9,000, or $9,900. They look for multiple deposits across consecutive days. They look for deposits made at different branch locations of the same bank, or multiple trips to the ATM over a weekend. When the software detects this pattern, the bank files a suspicious activity report for suspected structuring. This report goes directly to the IRS Criminal Investigation Division, and this is where lives get destroyed. Because the law was written to combat organized crime, it carries incredibly harsh enforcement mechanisms, the most brutal of which is civil asset forfeiture. Civil asset forfeiture allows the government to seize your bank account before you are ever convicted of a crime, before you are ever charged with a crime, and in many cases before you even know you are under investigation. If an IRS agent looks at your banking history and sees a pattern of structured deposits, they can take that history to a federal judge, swear out an affidavit, and get a seizure warrant. Imagine waking up on a Wednesday morning. You go to buy a cup of coffee, and your debit card is declined. You check your phone, and your bank balance, which had $50,000 in it yesterday, now reads zero. You rush to the bank in a panic, thinking you have been hacked. The branch manager pulls you into an office, looks at you with a grim expression, and hands you a piece of paper with a phone number on it. They tell you that your funds have been seized by the Department of the Treasury, and they are no longer allowed to speak with you. You call the number and you find out that the United States government has taken your money because your deposit history looked like structuring. Now you have to fight to get your own money back. But in a civil asset forfeiture case, the lawsuit is not filed against you as a person. The lawsuit is filed against the money itself. You will see court cases with bizarre names like United States versus $42,000 in U.S. currency. Because the government is suing the money, the burden of proof is heavily skewed in their favor. To get your money back, you have to hire a federal defense attorney. You will likely spend $20,000 to $30,000 in legal fees just to prove that the money was legally earned and that you were merely ignorant of the structuring laws. In many of these cases, the citizen simply runs out of money to pay the lawyers, and they are forced to settle with the government, letting the government keep half of their life savings just to get the other half back. All of this happens to completely innocent people who were just trying to avoid a form at the teller window. The psychology of the bank teller plays a massive role in this as well, and it is something you must understand. Sometimes a teller will try to be helpful. You might walk in with $10,500. The teller, knowing that a CTR requires extra typing and a manager's approval, might lean in and say, if you just deposit $9,900 today, we won't have to fill out the big IRS form. You can just bring the rest back tomorrow. If a bank employee ever suggests this to you, politely but firmly refuse. Tell them you want to deposit the entire amount today. Bank tellers are not lawyers, and they are not financial advisors. When they suggest breaking up a deposit, they are actively inducing you to commit federal structuring. If the internal audit catches it, the teller might get fired, but you are the one whose money will be seized by the federal government. You can never use the excuse that the teller told you to do it. The federal investigators will not care. So, what is the defense? How do you protect yourself from the $10,000 tripwire and the aggressive algorithms tracking your every move? The answer is radically simple, but it goes against every instinct you have about privacy. You must lean into the reporting. You must completely surrender the idea that you can outsmart the bank's paperwork. If you sell a boat for $25,000 in cash, you take all $25,000 to the bank in one single trip. You walk up to the teller, you hand them the money, and you hand them your driver's license before they even ask for it. You let them fill out the currency transaction report. You answer their questions honestly. If they ask where the money came from, you say, "I sold a boat." If you have the bill of sale, you bring it with you and offer to let them scan it into their system. By filing the CTR, you are declaring to the financial system that you have absolutely nothing to hide. A filed currency transaction report is not a crime. It is just a piece of paper. It does not automatically trigger a tax audit. It does not mean the IRS is going to kick down your door. Millions of these reports are filed every single year by perfectly legitimate businesses. The government is not looking for people who file the reports. They are aggressively hunting for the people who try to avoid them. The moment you embrace the transparency, the algorithms lose their power over you. The system is designed to catch anomalies, shadows, and evasive behavior. When you operate entirely in the open, depositing your large sums of cash exactly as they come into your possession, you become virtually invisible to the criminal algorithms because you fit the profile of a compliant, law-abiding citizen. Furthermore, if you own a small business that generates a lot of cash, you must ensure that your deposits match your revenue cycle naturally. Do not stockpile cash at home for a month and then randomly deposit smaller chunks to keep things looking neat. If your business takes in $3,000 a day, deposit $3,000 a day. If you have a massive weekend and take in $14,000, deposit the $14,000 on Monday and fill out the form. Consistency and logic are your greatest shields against the Bank Secrecy Act. If an examiner ever does look at your account, they need to see a clear, undeniable correlation between how you earn your money and how you deposit it. The narrative of your bank statements must make perfect, boring sense. We have covered incredibly heavy, vital information today. Let us quickly recap the most important takeaways so you can move forward with absolute confidence. First, understand that your bank is constantly monitoring your behavior through automated systems, and any sudden, unexplained deviation from your normal financial habits can trigger a secret suspicious activity report that could lead to your account being closed. Second, remember that the updated 2026 reporting rules, including the shift to the $2,000 threshold, mean that digital platforms are watching you closer than ever. Never try to split up digital payments across multiple apps to avoid getting a 1099 form, because the aggregation software will flag you for evasive behavior. And finally, the ultimate rule of banking survival. Never, ever break up a cash deposit or withdrawal to stay under the $10,000 limit. Structuring is a federal felony, regardless of whether the cash is legal or not. When you have a large amount of cash, deposit it all at once, fill out the form, and walk away with your peace of mind intact. This system can feel incredibly overwhelming, and it often feels like the rules are designed to trap the average person while the true criminals slip away. But knowledge is your ultimate defense. Now that you know exactly where the tripwires are buried, you can walk through the financial system safely. I want to hear from you down in the comments. Have you ever had a bank suddenly freeze your account? Or have you ever dealt with a teller asking aggressive questions about your own money? Share your experiences below, because reading your stories helps educate and protect everyone else in this community. Take care of yourselves, protect your assets, and always operate in the light.